We can conclude from the bond pricing exercise that an increase in the discount rate, which is the required rate of return prevailing at the time for that specific tenor, reduces the price of the bond, and a decrease in interest rate increases the price of the bond. This is a very important property of bonds we must remember going forward if we are to understand the impact of economic indicators on bond markets. Let us now understand why interest rates rise and fall in a very common sense reasoning, which we will build upon in later stages. During periods of high economic growth, the demand for goods and services is high due to higher incomes, higher employment, and an overall feel-good factor. Higher demand for goods and services causes higher prices, and higher prices causes the central bank to increase interest rates to cool the economy and inflation rates. We will see how this central bank intervention slows down the economy at a later stage. For now, we need to remember that high inflation and high growth causes the central bank to increase interest rates to slow the economy to a more sustainable level. In periods of low growth, the central bank lowers interest rates to spur growth, which in turn increases the demand for goods and services. We can now begin to make the connections between interest rates, inflation, growth, and the price of fixed income securities. In periods of high growth and high inflation, there is a risk that the central bank will increase interest rates to keep the economy in check. This increase in interest rates is bad for bond prices and hence bad for bond markets. Therefore, any macroeconomic indicator that indicates the economy is overheating or indicates any sign of inflation will cause a drop in bond prices. The higher the deviation from expectations, the stronger the reaction in bond prices. On the flip side, when growth and inflation have slowed to an extent that there is a concern the economy might slide into recession, then the expectation is that the central bank will lower interest rates to spur growth. This lowering of interest rates causes bond prices to rally and hence good for bond markets. Any macroeconomic indicator that causes market participants to perceive a slowdown in the economy is good for bond markets. In the next sessions, we will look at the basic principles and determinants of stocks and the economic factors that affect the stock markets.